Hi, I'm Mike Maloney, and I'm joined by Adam Taggart once again. Adam, how are you doing?
I'm doing great. Going to try to fill in for Jeff Clark again as host. I got to tell you, Mike, his shoes are real big, but going to do the best I can.
Well, you've done a great job so far.
Well, thanks. It's been a lot of fun. Well, look,
Yeah.
Mike, we got a lot to plow through today. And I think we got a lot of folks probably watching because at the end of last week, just to start with the elephant in the room, the precious metals took a big hit on Friday. And then they took a really big hit as the futures market opened on Sunday night. So, can we just dive right in and explain what just happened for folks?
There will be more data available when the commitment of traders comes out on Thursday or Friday. Uh, it, you know, when you have a level two trading platform, you can see all of the bids and asks that are on there. You can see the sell stops. You can see a whole bunch of different information than a consumer can see on a brokerage platform. And so the big boys, there's a lot of people that have to get out of their short positions to before gold and silver start a big rise. And so part of this is running stops. Part of it they're blaming on liquidity and the options expiration and stuff like that. Part of it's blamed on the interest rates. So tell me your take on it.
Well, from what I understand, and this happens from time to time in the precious metals market, why it's allowed, I have no idea. But $4 billion worth of gold futures were basically dumped at the open in the Asian markets Sunday night, America time, when the markets are much more thinly traded. And it just blew through the bid stack. It was just put out there as an open market order and just dive through the bid stack trying to find as many orders as needed to fulfill that 4 billion placed order. And the crazy thing about that is nobody who was price sensitive or cared about getting a good price for their gold would do something like that. They would sell it more gradually over time.
Right.
They wouldn't dump it all in a matter of minutes. Right.
Okay.
So that's what happened. And people are saying, oh, maybe that was triggered by the big payroll report that came out on Friday in the US. What happened in response to that, it said, hey, unemployment's going down. US Treasury rates went up a little bit. Basically, the logic being that, the Fed may have to taper or tighten sooner. And therefore, Treasury rates are going to go up and therefore real rates are going to start rising. And that's not good for gold. But as you and I will talk in a moment, Mike, I mean, this reaction is incredibly disproportionate to what we just saw on Friday.
One of the things that I would come back with, though, this flash crash that happened, how much the price of gold is still lower than before the flash crash. So if somebody dumped $4 billion on the market in super thinly traded hours, when they could see all of the bids and they could just run those bids, and they knew when they dumped the $4 billion worth of gold, how far down the price would go. Well, there's been a whole lot of buying that has happened between then and now. You've got quite a bit of trading that happened once the markets opened at a far lower price than gold was. So if that same entity had a whole lot more short position, a huge short position, so they sell, which increases their short position, but if they've got a whole bunch more shorts already there and they push the price down, they can actually make a profit by losing $4 billion.
Yeah. And Mike, I mean, it's very hard not to see this as just blatant manipulation, whatever the reason is, because they want to make money on their shorts or they want to bang the price down and then buy it, more at lower prices, or maybe even both.
Right. And, we will see when the commitment of traders report comes out later in the week, how much covering there was at these lower prices. If the covering at the lower prices offsets the $4 billion that was lost, then they got to run all of the bid stack, like you said, and they knew where the price was going because you can see how many bids there are out there for a certain quantity of gold that you're going to dump. So you can see where the price is going to go. when you're such a whale in the room during these super thinly traded hours. So it was blatant manipulation, yes.
Yeah. All right. So I've got a number of follow-up questions on this, Mike, and you've been following this market a lot longer than I have. I'm going to ask you what might be a rhetorical question here, but how is this allowed to continue? It's gone on for the 15 years I've been following this market. It's a chronic sort of feature of this market that these big whales get to push stuff around, and there really doesn't ever seem to be any enforcement of the regulation of these exchanges that comes and penalizes these guys. Do they just have so much power and so many political connections that the cops are just asleep on the beat, or what's the story here?
Well, I sort of like it. It got crushed down. I'm hoping it goes down a little bit more. I've got some targets where I will accumulate. I will increase my position. But the only way to beat it, if it doesn't, if they don't somehow figure out what the conflicts of interest are going on here and eliminate this type of trading, if they don't correct this, and I doubt very much if they will, then the way to beat it is to own physical. I don't feel like the price of gold went down and silver went down, but I don't feel like I lost anything. It's just an opportunity to accumulate more, because these are all short-term manipulations where they're just grabbing some cash very quickly out of the markets. The rest of the small investors become somewhat complacent. And so these big boys figure out how to take them for a ride and empty their pockets. But if you just have a physical position and you're not playing futures and options and things like that, you haven't lost anything. You've just been provided an opportunity to increase your position, because what I'm betting against is the dollar. I'm betting against the increase in the currency supply. I'm betting against central banks. I'm betting against modern economics and the way the global economy is run. I just think that ultimately there is a big failure on the part of these entities coming up, and it's going to show up as spectacularly high gold and silver prices. And I might mention, I have been sort of doing this now since October of 2003 is when I started investing. And so for anybody that is not like in a positive position, this is sort of a long-term thing. But when it comes to to monetary crises, everything goes along at a certain trajectory. I'm trying to flip the chart here. And then 80% of the move comes in the last 10% of the time. And so you're going to see fireworks someday. I don't know when. I've been waiting for it since 2003, but my gains in just being in this sector have far surpassed what I could have been in stocks.
Well, really well said. And I love how your mentality, in regards to sort of the unfairness of the short-term wanging around of the market that the big whales do, really to me sort of sounds like a judo move, Mike, where you're using their momentum to your advantage. And when they bang the price down, rather than fret about it, you just see that as a better buying opportunity than you had beforehand. And as you said, just let the long-term trend take care of you, with the expectation that when this thing really gets into high gear, most of the gains are going to be coming in that last remaining 80% plus of the move. Well, look, you also answered one of the other questions I was going to ask you, which is how is this affecting your personal trading, if any? Sounds like you just mentioned you have some targets. Just as a reminder to folks, we do share Mike's specific trades when he places them with our insiders at Gold Silver. So if you are not a Gold Silver insider yet, you should sign up for that.
This what we've been talking about does relate to a video presentation I did that you released on Wealthion, and basically, that's the video is how high may the gold price rise, but it's also about looking at the macro, looking at the long term of the fundamentals of the markets. What we've been talking about, this flash crash, is just that. It's a flash crash. It's a blip in the middle of this giant bull market that we're basically in. We've had this little pause in it, but I consider 71 to 80, a single bull market with a bear market correction, with a correction in the middle, that it's all one bull market. We're still in the bull market that started in 2001, I believe. And what we've been through for the past, almost a decade is a correction only. It's a mid-cycle correction. The rest of the move has yet to come. But I would suggest that people go and watch the Wealthion video, because you're going to, it's got some questions at the beginning, and the questions sort of set the fundamental economic structure that we're in. And then one of your viewers had asked the question, asked me the question, has any reserve currency, central bank reserve currency, ever gone into a hyperinflation? Because when they ask that question, people think they're catching me on something. And they aren't. You've got to watch the video to see why. There was a reason that all of the central bank, the reserve currencies or the predominant currencies had never gone into a hyperinflation up until 1971. And then that reason vanished. So, by the way, watch that video. We've got a big anniversary coming up on August 15th, this coming Sunday. So watch that video, and it gives you some perspective on what's going to happen on Sunday, August 15th.
Yeah. And just to call that out, that Sunday, August 15th, that is the 50th birthday of the U.S. fiat dollar. I put a little video out on that only because I turned 50 a week ago. So the U.S. dollar and I are almost Irish twins here. Mike, that video that you created that we're running on Wealthion, it is just phenomenal. I really cannot tell you how overwhelming the feedback's been on that. So folks, if you're watching this video, but you've not seen the presentation that Mike's talking about here, just go to youtube.com/Wealthion. Watch it there. It's the featured video there. Mike does a phenomenal job, as you just said, kind of really laying the foundational argument for why you really want to be in precious metals. So if for any reason the recent action in the precious metals getting banged around has you at all a little bit nervous, this will put you to rest. And then in addition to his phenomenal answer to, has a world reserve currency ever hyperinflated, he then actually goes into his calculations for exactly how high that he thinks gold should be able to go given current currency supply. And the numbers that he comes up with, given current supply, not even where we think it might be going, are pretty freaking staggering given today's prices. So, if you've got at all any sort of unease in your gut, go watch that video. It will totally put that to ease.
Those numbers that you call staggering are just if history repeats and gold and silver go into the same balance that they were in 1980. With the same balance with the currency supply. And so I love ratios and ratio charts. To me, they foretell, they show you what fundamentals are, and they foretell where the long term, with the direction that things are going to go.
All right. So if history is going to be any guide, and usually history is right, go watch that video and see where Mike thinks the price is supposed to be. Okay, real quick, just to move on here, Mike, let's get to the tweet of the day, which is a chart here. And this just sort of underscores a comment that I made earlier. This is a chart basically showing the real rates right now. And you can see there is a tiny little blip up in the long macro trend of real interest rates becoming more and more negative over the past couple of years. Tiny blip up recently, and people are using that to justify the 10% plus decline in gold, 20% approximate decline in silver that we've seen over the past few days. And I used the term disproportionate earlier, but this just sort of seems to be totally blown out of the water as an excuse. And Mike, let me ask you this: where do you think rates are going to go from here? Higher or lower?
Well, eventually higher, except there's a crisis coming. They're going to try and prevent it as long as they can. And when it happens, you're going to see them try, the Fed, to keep rates low, they have to purchase U.S. treasuries. When there's a crisis, if enough investors are rushing toward what they consider the safe haven investment of bonds. Rates stay low then. But if the investors stop buying, then it's the Federal Reserve buying up all these treasuries that are being issued just to keep the rates down. So because they see this, when the rates are low, they see it as stimulating the economy. When you prevent any savers from actually being able to save for retirement, and you cause people to spend, to borrow and spend. When rates are low, more people borrow. So more currency is created, and that causes bubbles to develop wherever that new currency is spent first. Usually it's in something like real estate, the stock market, because of margin trading and so on. So when rates are low, we go into warped economies and bubbles when they're artificially low, when they're not set by the free market. But the whole point of this chart is that little arrow and that little square. This is supposed to be the thing that caused the flash crash. And it's absurd. So, yeah.
All right, Mike, let's end on the thought of the day here, which I find really, really interesting. Let's bring up the image here. It's an image from Apple with some of its rock stars there back, I think, in 2008. Why don't you set the context for us here about what you think this image is telling us?
Well, so here's Steve Jobs and his crew introducing iPhone SDK, which is software development kit for developers. So if this didn't happen, there would be no third-party apps. There would only be Apple apps on your iPhone. This opened up the door. It doesn't matter what operating system your mobile phone is using. Maybe there would have been third-party developers introduced later, but this is what started the trend of all of these wonderful apps built by individual companies all over the planet. And when you look in your phone, it's probably 80 to 90% third-party apps, not apps that are provided by the company that makes the phone or makes the software, your operating system software on the phone. So this was an event that is probably actually bigger than the introduction of the iPhone. And I count 21 people in the audience. So it says, came across this photo of Apple launching iPhone SDK in 2008, Jobs and his guys on stage, a ton of empty seats. Seems key moments for the future seldom have an audience. And if you're fortunate enough to be there, don't expect fanfare or validation yet. And that's very much how the precious metals sector has been for all of these years. So, but there is a big payoff in the end. It's going to be spectacular. It's going to be as big as this software development kit introduction. It's just that the general media ignores it at the beginning of bull markets. I want to thank everybody for watching. Thank you, Adam.
Great pleasure, Mike, as always. Thanks.